90% of investors who enter the stock market lose money in their first 5 years. But in that same market, trading the same stocks, under the same conditions, a small minority consistently wins. What's the difference between these two groups? More money? A better computer? No, the only difference is 3 fundamental habits. Today, I'm going to explain these habits to you, and by the end, you'll see this. The stock market isn't an intelligence contest. It's a psychology test. Think about this. You have $10,000. You buy a stock, and the price drops 20%. What do? Most people sell, because the brain feels twice as much pain from losses as it does from gains. In behavioral economics, this is called loss aversion. Nobel Prize winner Daniel Kahneman spent decades researching this and found something crucial. People don't make rational decisions. They make emotional ones. This is exactly why most investors sell at the bottom and buy at the top. The exact opposite of what they should do. So, what are the winners doing? The first secret: listen to the system, not your emotions. Successful investors follow predetermined rules no matter what the stock price is. For example, a rule like this: if this stock drops 15%, I'll sell it, but I won't sell it unless it rises 15%. Because this decision is made in advance, panic doesn't override it. Emotions don't decide. The system does. This is where Warren Buffett's famous saying takes on real meaning. Be fearful when others are greedy, and be greedy when others are fearful. This isn't a feeling, it's the output of a system. The second secret: choose consistency over timing. A lot of people ask, will the market go down? Should I buy now? Research says something very clearly. Trying to time the market makes you less money in the long run than investing consistently. Let's say you invest $500 every single month. Whether the market is up or down, you don't care. This method is called dollar-cost averaging. Someone who invests $500 every month for 10 years generally walks away with a much better portfolio than someone waiting for the right time. Because one person acted systematically and the other was playing a guessing game. The third secret: make peace with losses. This is the least talked about but most powerful secret. Winning investors aren't the ones who never lose. They're the ones who don't fall apart when they tip. Research shows that over the long term, profitable investors typically have 30 to 40% of their portfolio in losing positions on average. Loss is part of the system. The key is spreading your risk so you don't lose $50,000 on a single stock. That's called diversification. And interpreting every drop not as the system is broken, but as the system is working. In summary, winners in the stock market aren't smarter. They're more disciplined. They listen to their systems, not their emotions. They choose consistency over timing. And instead of fighting losses, they've learned to walk alongside them. Now I want to ask you something. Which of these 3 habits are you missing? Write it in the comments. I read them. If this video helped you, like it and subscribe. Every week I release a new video on money psychology and investing. See you in the next one.